Hi, what's going on, guys? Good afternoon. Welcome to another video on YouTube. Today we'll be talking about fair value gaps. Fair value gaps. This is mainly for people that trade ICT strategy for beginner. So what I'm gonna do is work over you guys. Work today with you guys on what bullish fair value gaps are and what bearish fair value gaps are. So as you can see in this picture right here, we have a bullish fair value gap, which is the green candles, and we have the bearish fair value gaps, which is right here, the red candles. So first, I would like to let you guys understand what are fair value gaps, right? So fair value gaps is a price imbalance on the chart where the market moves too fast, leaving an inefficient area, right? Inefficient. This is very important. Inefficient area with little trading activity. These gaps are often act as zones, right? Remember, zones, where price is likely to return before continuing in its trends. So now I'm going to show you a visual representation of what a fair value gap says. For example, when you see these three candles, the first green candle, the second green candles, and the third green candles, right? To mark out a fair value gap, so what we do is the basically we're gonna mark out the end of this fair value candle, which is right here, this zone. The eye of this candle, the close, we mark it out, and the last one, the first one, which is this one right here, we're gonna mark out the bottom of it, and this one, the last candle right here, on the bottom, we're gonna mark it out. So in between them, as you can see, there's a space, there's a gap. They're not connecting together, right? If you have the wick like go all the way up here, like all this wick go all the way down here, then there won't be no fair value gap. But due to the fact that there's a gap between this first candle and this candle right here, that is called a fair value gap. So there are two types of fair value gaps, right? One, we have the bullish fair value gap, which is this one on the way up, and we have the bearish fair value gap, which is these three consecutive candles right here. So how to identify fair value gaps, right? First, you want to look for three candle formation. I stated three candle formation, one, two, three candles. The first candle strong momentum move up, and the second candle extend the move, which like create a gap, and the third candle doesn't fully retrace into the gap, which confirm the fair value gap, which means the first candle which create the move and the second move also create a stronger move, and the last candle doesn't fully retrace to the first candle, which create a gap in price, inefficient in price. Inefficient are also refers to as fair value gap. So, like I said, there's two different kind of fair value gaps. There's a bullish fair value gaps where price moves up rapidly and leaving a gap below, and the bearish fair value gap is when price drop fast, leaving a gap above it. So this is an example of a bullish fair value gap, and this is another example of a bearish fair value gap. And how do you use this in trading, right? I will also create another video, which will be a part two series. This is just giving you like a basic knowledge of what a fair value gap is. And how do you use fair value gaps in trading? One, entry point. We wait for price to return and react at an inversion fair value gap zones, but which is this right here, the space between these gaps or this space between these gaps. So I wait for price to come down, tap it, and we could get in there and put our stop loss below these gaps right here, or below this one here, or below here. And also on liquidity gaps, price often revisit fair value gaps to fill inefficiencies, right? Confluence factor that when combined with liquidity sweep, previous highs and lows, and market structure shift. And keep in mind, higher time frame fair value gaps like the 15, 1 hour, 4 hour daily fair value gaps is much stronger than the lower time frame fair value gaps, right? For example, if I'm looking for a trade to enter, I'll be entering my trade using the 15 minutes, 1 hour, or 4 hour or daily fair value gaps to enter trades. And also, example strategy for Nasdaq futures trading. Identify a fair value gap in a trending market and wait for price to return to the fair value gap zone. and drop down to a lower time frame, look for a market structure shift before entering a trade. Place a stop loss above or below the fair value gap. So, for example, if I'm going longs, I'll be entering my trade here between the gap and putting the stop either below this or below this candle right here. Or if I'm entering a short, I'm either putting my stop here on the second candle or the third candle. For beginners, I would recommend to always put your stop on the last candle, right? Also, for beginners inexperienced, put your stop loss right here, and also you could put your stop loss right here if you're going short, and if you're going long, you can always put your stop here for beginners. Okay, I want to also take profit at previous liquidity level or a fair value gap in the opposite direction. What does it mean of liquidity level? Basically, there might be like a relative equal highs or relative equal lows if you're going short. So if you're going longs, you might see relative equal highs up there. That's gonna give you the confirmation where to exit your trade. So I'm gonna go through another um in-depth video in part two of this fair value gap, where I kind of use the chart to explain more to you guys on what fair value gaps are. So just to quickly give you guys another example on the chart. So what I'm gonna do is I'm gonna show you guys. So this is another example real time in the chart. This is an example of a bearish fair value gap, right? Look, the low of this candle and the high of this candle, right? This is a bearish fair value gap. If I want to enter a trade, this is what I'm gonna do, right? I'm just gonna enter my trade here, right? So if I want to go short, I'll go short like that and put my stop right here at the high of this candle or this side of this candle right here, this candle here. So then I will target the opposite liquidity or the opposite fair value gap, which is right here, which is this opposite fair value gap right here. As you can see, another fair value gap here. 1, 2, 3 candle. The space between this candle and this candle is the gap, which is right here, right? So that is how I will use a bearish fair value gap to enter my trade. And I'm going to show you guys another example of a bullish fair value gap. Another example of a bullish fair value gap would be this gap right here. Let's count it. 1, 2, 3. So I'm going to mark out the high of this candle and the high of this candle too. That is my fair value gap, right? That is my fair value gap. So once I mark these eyes out, this one and this one, those are my fair value gaps. So what I would do is I usually use this box to mark it out like that, and I will wait for price to retrace in there. And once price retrace in there, then I'll be looking for market to continue on the upside. So let's play this real quick and let's see. So as market comes inside of it, guess what I'll be doing? I'll be buying. Once I buy, I'll be looking for this eye right here as a take profit. Let's see what the market does. Then just like that, the target hit. Guys, this is how you use a fair value gap, right? So I'm gonna return to the PDF. So actually, as I previously showed you guys how to use a fair value gap. Now, if you're interested in one-on-one coaching, I do offer that. Where I explain more in depth of all this strategy, right? I'm gonna put my link in the video description below. Make sure you guys subscribe to my YouTube channel to get more free content. Thank you guys so much for watching. Take care.